All right, we're going to go behind the scenes of a pretty high-stakes corporate earnings call. We're diving straight into the unscripted Q&A for Bellring Brands. You know, the company that makes those super popular Premier protein shakes. This is where we get to hear what Wall Street is really worried about. I mean, just think about that number for a second. 36 shakes every single second. It's an incredible success story, right? This brand is a monster in its category. And yet, when the company's leaders got on the phone with analysts, they got absolutely grilled. So let's break down that intense Q&A. You should really think of an earnings call Q&A like a pressure test. And for Bellring, the analysts zeroed in on three big challenges. First, the growing threat of competition. Second, whether they can keep up their explosive growth. And third, the squeeze on their profits. So let's walk through each one. Okay, so the first thing analysts really hammered them on was competition. I mean, the ready-to-drink protein shake category is just on fire right now. And that kind of success attracts a ton of new rivals, including some really, really big names. This was the big question hanging over the whole call. When a market gets this hot, everybody wants in. So analysts kept pushing management, asking how the number one brand plans to stay on top when the shelves are suddenly getting very, very crowded. What's so interesting here is how you can see the two sides of the debate. On the left, you've got the analysts' worries, a crowded market, more promotions, losing shelf space. But on the right, you see how Bellring's management flipped every single one of those into an opportunity. They basically argued that new competitors just bring more shoppers into the aisle, which grows the whole category for everyone. And to back that up, the CEO, Darcy Davenport, shared this little story from a recent store visit. Her point is that this stuff isn't niche anymore. It's a mainstream grocery item. So from her perspective, more competition just proves how big the market is. And that's a good thing for the leader. And here's the crucial detail. Management said that the most intense competition, especially in those big club stores, is because of a kind of a weird short-term situation. A retailer is just temporarily filling some empty floor space. They were pretty clear they don't see this as the new normal. All right, on to the next challenge. After a fantastic year of growth, analysts were hungry for more. They asked again and again in a bunch of different ways, what's fiscal year 2026 going to look like? This was pretty much the multi-million-dollar question. Everyone wanted to know, was this year a peak, or could the company actually keep this momentum going? In other words, is the party about to be over? And the official answer? Well, the CEO basically dodged the question every time. She kept saying it was just too early to give a number, which, only made the analysts press her even harder for any little clue they could get. So, instead of a hard number, management pointed back to their game plan. They argued that for the first time in years, all their growth engines are firing at once. They've got full capacity, great partnerships, new products, and they're back to full marketing. But is that going to be enough? Now, while they wouldn't commit to a target for next year, they did remind everyone of their long-term goal. The company has this standing algorithm, which is just their target to grow sales by 10 to 12% every year. It was their way of saying, hey, we expect to keep growing strong, just maybe at a more, normal pace. And now for challenge number 3, the money. Even with sales booming, some sharp-eyed analysts dug into the numbers and started asking questions about the bottom line. Basically, is Bellring sacrificing profits to get all this growth? This is a classic Wall Street problem, right? To fight off all these new competitors and keep sales growing, companies often have to spend more on discounts and promotions, and that eats right into their profits. Analysts wanted to know if that's what was happening here. And yeah, management pretty much confirmed it. They projected a pretty significant drop in their profit margin for the next quarter, down about 3 percentage points. I mean, that's a real tangible hit to the bottom line. So what's causing this squeeze? Well, it's a mix of things. Some of it, like the one-time costs for a new package design, are temporary. But other things, like spending more on promotions and paying higher prices for ingredients like whey protein, are expected to stick around. And looking ahead, they were pretty upfront that some of these money problems aren't going away anytime soon. They specifically said that high whey costs and even some new tariffs on dairy are going to carry over into next year, keeping that pressure on their margins. So, after getting hit with all these questions on competition, growth, and profits, what was Bellring's ultimate answer? Well, they kept coming back to their core strategy, which we can basically call the Premier Protein Playbook. Their whole game plan is built on this trifecta: They believe people choose Premier Protein because it nails three things. It's easy to understand, it tastes amazing with a ton of different flavors, and it has the nutrition people are looking for. The question is that enough to fend off everyone else? This was a really interesting point they made. A lot of the new competitors are talking about fancy ingredients, like ultra-filtered milk. But Bellring says their research shows customers don't really care about that. They're betting that as long as they deliver that great-tasting milkshake experience, people will stick with them. And finally, their innovation isn't just random. It's a clear three-part plan. First, lead with cool and exciting flavors. Second, create new products for new times of day, like their indulgence line. And third, expand into totally new areas, like they're doing with their first non-dairy almond milkshake. So that's the story from inside the analyst call. The company has laid out its playbook for handling the competition, driving growth, and managing costs. They're betting that their brand, taste, and innovation will win. But in a category that's changing this fast, you have to wonder, will it be enough?